Welcome back. Markets are just 6 points away from 26,100 levels. Well, other than that, I think much has happened so far. Well, let's get in Vinay Jaising, the MD and co-head of Portfolio Management Services with JM Financial. Well, Vinay, to start off with, global markets have continued to remain volatile, but Indian markets have been scaling new highs every new day. 26,100 is the target that we are now achieving, and we're just 5 points away from that. What's your view when it comes to the overall Indian market? Also, given the fact that there are recession talks that are happening still in the global market, how are you viewing all this together, and what's your view when it comes to the Indian markets?
Thanks so much for this invite. First, let's look at what's happening globally. Fed has cut its interest rate by about 50 basis points. History shows you since the turn of the century, what you've seen about 350 basis points plus cuts which have happened, and each and every time it has happened, it's followed by recession. Three times, once during the tech bubble, second time during the GFC, and the third time during COVID. In two of the three times, the M2 kept on coming down, so the money supplies kept down and the markets globally corrected between 20 and 30% over a 1 year time frame. In the case of COVID, actually the M2 reduced, but very quickly the government globally spent a lot of money, and you saw a lot of what was corrected in the market for the first 3 months post-COVID and the recession. It came back into play and the markets were smiling. This time, when the Fed is cutting the rates, I think they're looking at stopping the QT, increasing the QE, which means they realize that M2 is a must so that the market stabilize. In this background, when you're looking at India, which was probably the best performing market last year, this year it's up at about 26% as against the rest of the world, which is up at 20%. India doesn't need to cut rates as much as Fed because our market is very robust. Our growth is already there. And we've also seen the debt market linked up globally, with us including in the global EMI index. So you're seeing the cost of capital of India going down irrespective, but you may not see the cuts similar to that of US. So net, I think what you got to look at is India will continue outperforming US because US is cutting rates because you've seen a slowdown there. It's not a recession. In India, you'll see rate cuts probably happen so that the capex mode of the country goes up. So we are pretty constructive in the longer term for the country. But in the shorter term, yes, the market has moved up quite a bit. So we think, the upside to downside will be plus 10 to 12% on the upside and minus 4 to 5% on the downside. So it's still skewed towards the upside, but with a 12 to 18 month impact. One last comment. The reason I say this is the liquidity today, which the country is witnessing, both from domestics as well as from FIIs, especially in the last 3 months, it's up at about $13 billion post-election, is unprecedented. And that number is only increasing. FIIs are at a 10 to 12 year low currently, and domestic inflows have been as much as $4 billion per month, both from DIIs as well as pure retail. So this is really letting the market not correct. Even if there's a big correction, you'll see mutual funds come and buy the market.
Just saying that India does not need to rate cut as much as the US does, given the fact that our growth is still strong. So from when are you expecting RBI to begin the rate cut cycle?
So our bet is sometime in December, but whenever they do that, it will probably less than half what the US people cut their interest rates by. So if we expect US, let's say, it's cut its interest rate by 50, and probably by the next 9 to 12 months, they'll cut another 100 basis points. Out of this 150 basis points, which US would cut, India would probably cut half as much in the same period of time.
You are saying, and obviously the data also suggests the fact that FI ownership continues to remain low in India. It's at a 12-year low. But whenever we see FI buying even coming in, financials is one sector where there is no interest that we have been seeing. Even the valuations are cheap. The sector has underperformed. How are you looking at financials as a sector, and do you expect the sector to outperform at least for the rest of the financial year?
So Pooja, our analyst, is a lot more constructive on the non-banking financial space than the banking financial space. As a space, the financial sector, we are also underweight. The reason we are underweight is if you look at the loan book growth, it is robust at 13 to 15%, a lot more robust than what it was, let's say, in the last 5 to 6 years. But what you're seeing is all these companies have become a lot more efficient. They do not have any provisions of COVID left, which they had to cut down. So earlier you would see the bottom line growth of private banks or even public sector banks grow between 30 and 60% CAGR, depending on the company we are talking about in the last 4 5 years. That number will go in line with the loan book growth or a little lower. The incremental growth coming in the loan book will also come in from the corporate capex. Corporate capex yields lower interest rates for the banks. And in the interest rate cycle, which you are coming, if interest rates itself are going down, the other places also where these banks would earn would go a little bit lower. On the other side, there's a deposit. I won't use the word crisis, but to raise funds, the banks are paying a lot more because there's too much of deposit requirement because the loan book has grown more than the deposits. So we can see some squeeze in NIMs as well. So we are not as constructive the financial space or the banking space as compared to other spaces where we think there's a lot more money to be made. In the banking space, we are very excited about some private banks, but more so the housing finance banks, because we think that's a single point area where in the budget the government had increased the capex spend. So we are putting a lot of our eggs in the NBFC space, largely in the housing finance part.
When it comes to FMCG, after an underperformance that we had seen for the first half of the calendar year, in the last 3-4 months, we have seen some strong share price move when it comes to FMCG. Also, data is suggesting that rural demand is expected to be good on the back of good monsoon. Valuations were not that expensive, but right now, how are you looking at the consumption and the FMCG sector as such?
So again, I'm going to give you, two examples. Historically, we made a lot of money in FMCG names, especially in likes of, let's say, Trent and Varun. Incrementally, what we are looking at is the pharmaceutical and specialty chemical space looking a lot more robust because A, domestic formulation growth is fantastic. B, US is looking at a lot more India dedicated Make in India stories, for investing in their CDMOs. So we're seeing a lot more safety net come up in the pharmaceutical and specialty chemical space, and the valuations there are also in lots of places about sub 20 to 25 times 1 year forward P, and you've got an earnings growth of at least 20+% and very interesting growths. So we are putting a lot more of our eggs in specialty chemical and pharmaceutical as compared to in the consumption space, purely because of valuations.
And when it comes to the telecom sector, you seem to be quite bullish about that sector as well. But could you tell us what are the key triggers because of which you're so bullish? Because I can't see anything other than tariff hike that could be one of the key reasons for being bullish on telecom.
I think that's the single biggest reason for you to be bullish. Think of it this way, right? If you're a company with 300 million customers and you increase the tariff by 10 rupees, you're getting 3 billion in a month. Multiply that by 12, you're getting 36 billion in a year. The tax rate is 25% and there's about license fee about 10%. So about 65% of this 36 billion or as much as 20 to 25 billion straight goes to the bottom line for any company with 300 million subscribers. Now think about it that I'm talking about a 10 rupee price hike. Why can't the price hike be 100? Right? So the same number of 25 billion can go to, into 10, about 250 billion or, $3 to $3.5 billion can be the profit growth for lots of these companies. The Indian ARPU is probably at its lowest level in the world. The Indian data transmission rates are amongst the lowest, but in terms of charging, they're extremely low. We are using a lot more data. Our GB of consumption is going up by the day. If you want good quality data consumption and the operators will have to raise tariffs, I think that's one thing which is bound to happen. And consumption is not going to go down. So for us, it's a simple consumption story. If you were to say FMCG, I think telecom fits that bill. You have to just multiply the ARPU by customers. And I think that's one thing we're very confident on. Both consumption is going up. So a single customer will need 2 phones. More importantly, the ARPU is going up and the maths of that leads to fantastic bottom line. FCF positive because finally most of the spectrum fees are behind you. 5G capex spend for the operators are largely behind them. So now's the time for them to reduce their interest rates, increase their ROEs, and that should be very positive for the markets.
Lastly, before we let you go, 5 stock ideas that have given Tata Power, Sterling Wilson, Windless Biotech, Innova Captive and FDC. Now, of these five, three, that is Tata Power, Sterling and Windlass, belong to the clean energy space. But why Innova Captive and FDC?
So FDC, is known pharmaceutical name, though people consume FDC virtually every day. FDC is one of those companies which sells Enerzal, Electrol, and Ziffy. Now think about it, right? Enerzal and Electrol are brands which are so strong variants. We talk about gate rates, but this company is focusing on the same way to market their products. The bottom line of FDC is growing again between 20 to 25% per annum. Its ROAS is north of 20%. Its P is under 21, 22 times 1 year forward. So that's why FDC, it's a pseudo consumption and pseudo OTC and pharmaceutical name, which is very defensive. Moving to the second name, you said Innova. Innova Captab actually is also in the pharmaceutical sector. It's a CDMO play. It's the top 3 in the country. Today, what's happening with most of the domestic formulators, they are keeping on outsourcing their requirement. They produce as much as 75-80% of their own requirement and start giving out as much as 15, 20, 25. That number's gone up to 30 and go up probably to 50-55% in the next 2 years. Companies like Windlass and Innova gain substantially because of this. And this is the domestic part of the story. Obviously, there will be some global CDMO selling, which will also happen in the future. So great plants, as you keep on consuming more and more domestic formulations and as they keep on giving more and more orders to the CDMOs, Innova Captab's bottom line keeps on growing. Again, the same logic, the ROAS is north of 20%, the PAT growth is north of 20%, and the P is under 25. So, it fits the story of, investment for us, which is sustainable growth at reasonable valuation.
Thank you, Vinay, for joining us and for giving us all those details and for putting things into perspective. Well, with that, let's slip into a short break and we'll be back with more news on the other side.